Hey everyone, it's October 31st, 2015. Happy Halloween to anyone who celebrates Halloween, but if you're someone like me who doesn't really care for Halloween, then it's another happy day. I just think Halloween is just a waste of money and time, to be honest, but whatever. Um, the last weekly video I made was on the third week of September, and obviously a lot has happened since then. The S&P and global indices are not only sharply higher from their September lows, but the dynamic to the trade has changed substantially, which is important to take note of. I'll do my best to cover this aspect as we review the chart of the S&P 500. But before I do so, I want to cover 3 points that I think merit some recognition. First, I want to thank two individuals who took the time to send me an email and thank me for the weekly videos I've uploaded and offer some advice. As you all know, I welcome any advice as it's constructive and respectful. You know, as it usually is, I've had a few nasty comments on some of the blog posts and on a couple of weekly videos where people saying that I can't write. My response to them is, I can't write. Why are you even reading? Or so many people saying that what I'm saying is a bunch of lies, or that it doesn't have anything to do with the markets, or that it doesn't make sense. I mean, if you don't like the material I present, then don't read it. I mean, it's free, and if you actually take the time to write a comment, it shows that you do care. So you're just contradicting yourself on that end. And secondly, on the weekly videos, people are saying that I mumble a lot when I talk, and that's me. That's who I am. It's part of me. I've said it from the very beginning. I'm not a good orator, nor do I want to be. I'm not a public speaker. The job that I do doesn't require me to speak much, so I really could care less. Um, so with that said, for the people that actually do care about the content I deliver, both on the weekly videos and on the blog section, I want to thank you for, again, taking the time to review all that material, which I think will help you and help you remain engaged, which is ultimately what I want to do. So these weekly videos are really set out to be informative, engaging, and change the way you, as a novice or experienced trader, approach markets. That's really my end goal. And by doing so, the only way I know I understand that I can do so is by providing quality, high-class content. If I deliver that quality content, the consumer or the viewer in your position is going to be there. So, I want this to be a mutually beneficial sort of arrangement or bond, if you will, that I think could help both parties tremendously. Second, I want to remind you to visit our website at least once a week and click on the blog link, which will redirect you to the blog section. As commented previously, I will from now on post 1 to 2 blog posts each month on recurring conversations or ideas or topics, and or some completely new topics. I talk or discuss everything from the broader markets to the broader economy to reviewing a few individual names on a case by case basis, to offering some solutions, to discussing recent market events on specific stocks or sectors, whatever. If you're an avid follower of these blog posts, you've noticed that in each blog post, whether it be at the beginning or at the end, I always ask a question. And the reason I do this well, there's a lot of reasons to it, but the two biggest reasons is A, my in asking questions in a in a blog, I do so because it helps me as a trader. It helps me broaden my horizons to aspects of the trade that I didn't know of, that I didn't know existed, or completely sort of rejected from the very beginning. And by doing so, I'm going to be able to set more profitable trades that are going to help me keep me in the game or in the investment practice longer than most people. And secondly, hopefully this will also lead you to ask more questions, not just about market-specific events, but about everything. As you all know, markets are reigned by cycles, just as anything else in life. In this physical world as we know it, everything is reigned by cycles. So if you care to ask questions, broaden your horizons, challenge the status quo for the purposes of broadening your horizons, your understanding of everything. It's believe me, it's only gonna help you. So hopefully this sort of promotes you from asking more questions about whatever it may be. And lastly, performance-wise, for the year we're up 16% on aggregate, 3.5% on a realized basis, meaning not accounting for open positions. These are not great numbers. I'll be honest, these are not numbers I'm particularly proud of, because I know we can do better. I know improvement can be made. Now, if you compare these results to a broader benchmark over the same time period, meaning from June to October, we're outperforming the S&P 500 index. But the people that use this sort of idea of saying when money managers say, oh, we this fund or the fund I manage or or overview whatever outperform the index, something like the S&P 500 or whatever, by 3%, shows that our performance is higher than that of an index funds, and since our costs are essentially a bit higher than index funds, it'll compensate for the added reward that our fund offers. They'll use whatever sort of chicanery they can to sell you a fund or sell you an idea to get you in the fund. I don't want to do that. Rarely do I put myself or compare my results with anyone else's or with an index fund because it doesn't give me or you any added value, right? What you care and what I care is how well or how profitable the trades essentially are and how we manage those positions. Um, and the other part, of course, is the informative part, which, again, I'll be honest, a few members don't really care for it, and some investors and traders I know don't really care for that aspect. They only care about, you know, executing profitable trades and making money, and that's fine. I mean, that's them. But if you're someone like me who also likes to gain more information, and more experience, and really, again, gain a firmer understanding of why markets act the way they do or behave the way they do, and what essentially that tells us about what might lie ahead, I find that fascinating, right? And that's part of the reason why I'm so immersed in the world of investment, and that's why, to be honest, I have a strong passion for investing. I mean, I'm not gonna lie, I like investing because the market is essentially a platform, one big platform with different people, with different backgrounds, with different objectives, different restraints, different or restrictions, different goals, different approaches, all convene to essentially execute their idea of what a good trade or investment may be. And because there's so many varying um, factors, or there's so many contributing factors rather, in between all that confusion, that complexity, right there is where opportunity is essentially created. It's up to you, the investor or the trader, to take that leap forward and really, again, begin by asking yourself questions, and from there take the next step and broaden your horizons before you narrow them, because a lot of people, if you're a technician, the first thing you do is you narrow your vision about what price did a day ago or a week ago or even a month ago, right? But really you have to start by broadening your understanding of markets, and from there you can begin to narrow your view on sort of the minutia of the of markets. So that's what I intend to do. I am fully confident that by next year, our returns are going to improve greatly, mainly because we're in the process of trends moderating. And once a well-defined uptrend or downtrend is established in the markets, our swing trades are going to benefit much more because, again, we're going to be able to manage around those trades much more effectively, and we're not going to run the risk of getting stopped out because of a very narrow range, or because of expanding volatility, which is what we had a couple of months ago. Excuse me. So So now onto the chart of the S&P 500. This week, or in this week's video, I'm not going to cover as many charts, whether it be of indices, sectors, or individual names, as I normally do. I've dedicated this video already in part to bring you up to speed to our recent performance and our latest developments at SmartStocks. And also, I want to, the point of making this video is to sort of share with you a few tidbits of useful information that I think will serve you well if you're someone who has traded the markets but hasn't had that much success, or has avidly watched markets but haven't really committed capital and are in the process of committing capital and whatnot. So this is hopefully informative to those of you who want to gain a sufficient edge, or who just want a second opinion. For the S&P 500, it's rather simple. There's not much upside or downside from current prices, meaning I'm not expecting the S&P 500 to break to new all-time highs by the end of the year, nor do I think an imminent collapse is at hand. Based on current circumstances, November and December are likely to be inside months, meaning they're going to fall in between the range of the range we saw in October. There needs to be a correction over the next few weeks and possibly a couple of months. Corrections, as I've pointed out repeatedly, can be produced in two ways. One is through price, where you get a correction in price to lower support levels, right, before they are retested and broken below, or before price essentially reverts back to the upside. Or the correction can happen through time, where essentially a lengthy consolidation phase takes place, and as a way to work off overbought or oversold conditions before the next leg of the rally shapes up. So it's my belief that most likely than not, we're going to see an extension of the consolidation phase we got in the first half of 2015 into year end, and more likely than not into the first and possibly second quarter of 2016. Now, just because if this were to happen, it doesn't mean 2016 cannot be a positive year for equities. Just look at the month of October. It only takes 1 month to have a good year in equities, right? So even if you consolidate for the first quarter and second quarter of 2016 and then rally into year end, it still means we will have a good year if that's your thinking going into 2016. Same can be true of the downside. Where you'll consolidate, sort of distribute back at the higher end of the range before we capsize and break lower. So those are all they're all fair expectations that could actually happen. Now, what am I focusing in on as far as price is concerned? Well, again, I've slapped a few Fibonacci retracements, which never hurt, and I think will give you a better sense what to look for going forward. It is my belief and expectation that the S&P 500 will, or has the ability to, but won't necessarily trade down to its 50% fib retracement from this year's range. In other words, the S&P 500 can trade down to 1980 or so, 1980, 1981, retest lower support points before it resumes the uptrend and breaks out to new highs in 2016. Now, if there's going to be new highs established in the first half of 2016, the S&P cannot end any month of this year, right? Cannot end the month of November or December below the 61.8% fib retracement, which stands right now at 201.67 on the spiders. That's roughly 2016, 2020 on the S&P 500. A close above 2016, 2020 the S&P 500 would show a higher level of conviction in the market that was not present before, which is needed if markets are going to trade higher. B, it shows a higher commitment of capital by investors, whether it be retail, institutional, private clients, hedge funds, mutual funds, all this, right? it means a higher commitment of capital at this higher range, which in time will take care of the consolidation phase, which initially was distribution in nature at between 2045 and 2130 in the S&P. And thirdly, more importantly, it will change the perception people have towards the markets, and that is extraordinarily important when assessing market conditions. It's not the only aspect of it, but it's very important. So again, 2016 to 2020 absolutely must hold in the S&P 500 if there's going to be a projected move higher above the highs in the first half of 2016. If the S&P comes down to retest 198.09, but closes above the 50% mark, most likely not, what we're likely to see is consolidation through at least the first couple of months of, up to February of next year before there's any possibility of a breakout. To break out or break down. And the third option is that if the S&P trades below or closes the year below 1980, and reopens in other words, if the S&P trades below 1980, it'll revisit the lower trading range and open the possibility, or actually confirm, an extended consolidation phase to the one we got at the beginning of the year that extends through the first half of 2016, and it won't be until the second half of 2016, where there will be a possibility of a breakout or a breakdown. So those are sort of the three main scenarios that I'm keeping a close eye on to see which actually takes place. Because right now the potential for upside is limited, as is the potential for downside, I've decided to take risk off the table. Like most people, a month ago, it's funny because a month ago people were confused, which drove them to being angry about markets. People were saying, "Oh my God, the S&P is about to break 1840, which is the October 2014 low, and if that is taken out, then we're watching the mid 1700s. 1780 was the point I pointed. If that gets taken out, we're looking at the 16, even 1500s. So it could have gone really ugly really quickly. That didn't happen, of course, because the ECB has now introduced the crazy idea of if need be, introducing negative interest rates in all of the European Union. Switzerland already has a negative interest rate, and Sweden, or the Riksbank, is also offering negative interest rates. So it's beyond me how anyone, how a consumer in those countries can afford to live there, and b um, really just deal with the fact that you're basically getting, day by day, each day the government is taking money away from you. It's essentially what's going on when you get negative interest rates. So I just don't understand how that dynamic is in any way beneficial to, well, of course not beneficial to savers. It's going to help um, acquirers of debt a lot. But again, what all this does is shuffle the obligations from one end to the other, propagate and fuel this credit bubble even more, and or intensify to a point where really there's it's structural reform um, is the only thing that's gonna really uh, change the course of history. Um, to put it in a different way. So that's what I'm looking for in the S&P 500. Sorry, I got sidetracked there, but that's really the main points I'm assessing. So because upside is limited, and so is the downside, at least from my perspective. And that doesn't mean there's not going to be opportunity from here to year end. There most likely will, but because there's such a limited upside and downside, I decided to just pair down risk. You know, uh, I don't really care to admit it. This week I had a bad week. I placed a bad trade towards the end of the week, and I realized then, after I fumed a little bit, I realized that my initial projection was wrong, and that drives me to reassess market conditions and to reassess my overall conviction and approach towards markets. You know, there's different ways to handle a losing trade and winning trades. It all depends on your personality and how you approach risk, how you feel with a particular trade and whatnot. I mean, there's a bunch of components that contribute to how you manage risk overall. For me personally, whenever I feel uncomfortable or I feel that risk needs to be taken off the table, I immediately withdraw most of my money, if not all of the money, to my bank account. Why? Because once I've had this nag almost previously, where whenever I place a bad trade, I find this urge to trade again, to revenge trade, and to try to make my money back, or at least part of it. And I've noticed that, by sort of not back testing, but reviewing previous trades that I've made, that it only leads me to produce more losing results over time. It's sort of the same idea as when you dollar cost average into a losing trade. More likely than not, that trade you're gonna close it out for a loss. It could be a smaller loss, or sometimes, and in fact most times, it's gonna be a bigger loss than you imagine. So just because, to prevent myself from making a bigger mistake, I have to do that. I have to remove the money from my brokerage account, so I don't have the ability, right, the means to trade it. Otherwise, I would commit bigger mistakes that was essentially set me far back where again I'm not going to be in a position where I can profit longer term. So there's people that are really unfazed by this. There's some people that don't know how to manage the stress and the overall the overall and the overall balance of the trade, and they just, I don't know. I mean, this sort of revenge trading where they place other trades, whether it be doesn't have to be the same stock. They just place other trades on other stocks, and it just drives them nuts. To the point where they just blow up. So because I've seen this, because I've experienced it firsthand, this is just how I like to approach markets. So right now, because I'm sort of indecisive, even though I'm even though I'm bullish or cautiously bullish, but I'm still indecisive. I rather take risk off the table, and one way of doing so, from my perspective, is to simply withdraw the money from my bank account and leave a small amount there, just in case. So for me to remain committed to this market and open long and short positions, I'm going to have to see what I explained before, which is high degree of conviction at higher prices, higher capital commitment, to essentially work off the distribution or the selling out of shares at the top end of the previous trading range. And the other important point I need to see, and I'll end it with this, is that what characterized the move off the September lows up to where we are today was the infusion of cash or capital into big cap names, specifically big cap companies within the United States. We've seen a shift away from small cap to big cap. So the third point that needs to be met for me to feel more comfortable in taking risk in general, and I think this will also help other people take more risk, is that we need to see the gap, the performance gap between large cap and small caps within the US, right? Looking at it from the domestic market, we need to see that performance gap narrow. In other words, we have to see the IWM begin to perform up to par with the S&P 500. And likewise, if this new rally or this new phase, right, is going to be characterized by big caps benefiting at the expense of small caps, then big caps, not just in the United States but in other countries, will also have to begin to we need to begin to narrow the performance gap again between large caps in the United States and large caps elsewhere. A good proxy for big and mid cap stocks of the world, ex US and Canada, is to look at the EFA. So even though this chart is not a log scale, it'll give you a misinterpretation depending on your time frame of the under or outperformance of a given index relative to another. But it's pretty clear that the outperformance of the S&P 500 over the EFA is quite sharp. Now, I mean, if you were to write once you standardize this chart, right, you put it as a log scale, and you draw a bell curve here over this chart, you'll see that we're close to trading over. I mean, I'll have to do this with the other software I have, but roughly a standard deviation That that's pretty big. That deviation will have to get narrowed over the next few couple of months to really show me that there's a high degree of conviction, not just in U.S. stocks but elsewhere. What does this tell me? In a broader sense, it tells me there's a favor favoritism, or people prefer U.S. stocks currently over the rest of the world. If you remember, what characterized 2014 by and large was the outperformance of European shares relative to U.S. That began to peter off towards the end of 2015 and as we entered 2015. Now, with the current rally, it seems as though U.S. stocks are beginning to outperform and remain in favor relative to the rest of the world. It doesn't mean Japan, right? The Nikkei or the Shanghai Composite or the DAX, the FTSE, and all these other indices. It doesn't mean these indices can't rally. And most likely the U.S. rallies, those indices will rally. But as a performance basis, the U.S. is likely to outperform the rest of the world, um, at least through year end and most likely in 2016. The fact that interest rates are likely to rise in the U.S. in the first half of 2016 is part of the reason why we've seen an outperformance, and the fact that the U.S. dollar is also getting stronger also adds to this performance discrepancy. So those are some of the things I'm looking at. Again, I've noticed a lot of observations over the last months, most of which I haven't shared, but I'll try to do my best over the next few weeks to try to share as much information as different circumstances unravel. I want to thank you for taking time to watch a video. I know I went a little bit over the 15-minute mark. I promise next few videos will be less than 15 minutes. I'll talk to you not next week because this is next week's video, but the following week. Um, I'll let you know when there's a blog post up and running, and I wish you the best of luck. Remember, respect price for what it is, for it's what it pays, but do not trust marketing. If there's one thing that I'm going to repeat ad nauseum because I've lived it, I've been in the trial of fire, if you will, too many times, more times than I would like to be in, and more times than I like to actually accept. But I've been in the trial of fire many times where um, the market will show you how big it is and how, no matter how much you think you can influence a market, whether you're an individual person, an institution, a bank, whatever, the market cannot be continually uh, intervened or manipulated as one would like to think. And again, when times the trades go your way, it's extremely important that you remain humble and focus on the journey rather than the end goal. And when you put bad trades, you have to understand then more than ever how to manage risk, or how to trade risk off the table. Like I mentioned before, I like to basically liquidate my account and leave little money when I don't have that high of a conviction. When I feel the market is offering me a more compatible and compelling case to invest, long or short, then I'll invest more money. But it all goes with how your trading style, how you approach markets, and more importantly, how you deal with losses and gains. So again, thank you for taking time to watch the video. Um, November and December likely be uneventful months. Yes, we have a Fed meeting in December, but I don't think they're going to move until next year. But again, we might get a surprise, and if it does, it's going to be interesting because I'm not entirely convinced we're going to get a massive sell-off as most predict. Um, in fact, U.S. markets, on a historical perspective, you can do this yourself. Um, from a historical perspective, the U.S. markets have done the best in during the initial rate hike. In other words, the 6 month performance on a 5 day rolling basis, the S&P has posted above average returns during the first 6 months of an initial rate increase than during any other period. Even better than when there's rate cuts. And that's because, again, there's a general assumption that the broader economy is doing better. Of course, that applied before when there was an actual intention to move interest rates progressively higher as the economy did better, right? It was a way to compensate savers, half of, if not more, of the market. But today, we're talking about a 0.25% increase for a full year, and they might not even hike interest rates. So it's different. You have to understand that change circumstances have changed, and you have to change with it. So, but thank you for taking the time to watch the video. I know I'm repetitive. I'm sorry. Again, that's just who I am. I'll try to cut all this rambling as much as I can, but it's just it's how my mind works. So um, I'll talk to you in a few days time. Keep safe. Thank you.